Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, let's get on to what we're going to look at today. If you haven't seen this before, this is a long-term chart that I like to present to give some real perspective, some real, if you step back perspective. Unfortunately, we tend to all be very short-term oriented. I plead guilty to that too often. Sometimes we're shaking out of good trades if we don't have some perspective. And again, not that you're going to trade off of this chart, but I want to make some key points here. The black line here is the chart of the U.S. dollar index going back to 1971 when the dollar started floating. Up until then, the U.S. was on what's called the Bretton Woods fixed exchange rate system. The world was on that system where all the major currencies were pegged in a certain amount to the dollar, and they could exchange that for gold at a certain parity. Well, Nixon realized that the U.S. was losing a lot in their financial status. It was giving away a lot of money during the Great Society days of Johnson. We had the Vietnam War, and gold was flowing out of the U.S. So Richard Nixon, John Connally, who was the Treasury Secretary, came to Nixon and said, "Hey, the gold's flowing out of Fort Knox. We have to do something." That's when he closed the gold window, and that's when really the currency markets, as we know it, started, 1971. So I wanted to show you here how the dollar has performed. The dollar index, of course, went right down into a bear market. Then we had a bull market started around 1980 when Fed Chairman Volcker came in and hiked up interest rates. Then we had what was called the Plaza Accord because the dollar was too high, so they lowered the value of the dollar. The Plaza Accord was really an implicit way to try and push the Japanese yen higher in value. At the time, Japan was about taking over the world then, as we know, very similar to China here. They're blowing and going on exports, so they were trying to weaken the value, increase the value of the Japanese yen was the implicit idea for the Plaza Accord, even though they said the dollar was too high. So, sure enough, the central banks got together and pushed down the dollar, that black line going down. And let me grab my little pen here, I'm sorry. Going down here, this was the second major bear market. Bear market 1, bull market 1, bear market number 2. It lasted until 1992. And in this range, we got the tech boom came into play. If we all remember, the NASDAQ just took off like a rocket. Well, the stock market took off, foreign direct investment rolled into the U.S., and the U.S. dollar rallied in a big way. Then we had the tech bubble popped right in here. Greenspan pushed interest rates down to 1%. He put on a big party. Everybody started creating and using derivatives in a very, very big way in the global economy. And the U.S. dollar funded all those that party for 7 years until the party came to an end with this thing we call the credit crunch. Couple points I want to make here. Number one, the dollar does move in major bull and bear market trends. If you read most newsletters, you would think the dollar only goes down, but the reality is it does go up in time. Second point we want to make, and this is key to really what this story is about, and again, it's our story, so to speak, is that there are major global macro events that, again, with the gift of hindsight, we never know at the point in time, that usually change the path of the dollar for a major trend. And in this case, we think the credit crunch is that sea change in the global economy that has changed the trend for the dollar, and we'll explain that. Most of you may think, well, the credit crunch was caused in the U.S., and the U.S. created this thing. There's some truth to that, but it's not complete truth. But needless to say, people say, well, how could the dollar rally when we've created all the problems and we have all these problems? Another point I want to make is that keep in mind that currency trading is always a relative game. You can never evaluate your currency alone. It always has to be against other currencies. So in this case, what we're talking about is some major capital flow that has benefited the dollar regardless of what's going on in the U.S. economy because things are worse elsewhere. So a lot of this move that we've seen so far is this risk move, and I'll get into that. So anyway, the key is it moves in major bull and bear markets over many years, and we think a new one has started. We think a new bull market has started in the dollar based on the credit crunch as the major global macro driver. we've termed this period the ice age that we're into now, this credit crunch. And we've used Al Gore, Mr. Global Warming, as a very good example of the hot part of the cycle. And that on the right is supposed to be ice pack there. Yeah, kind of freezing there. Sorry if it wasn't clear. But the point we want to make is during the last cycle, again, from that dollar bear market cycle, demand was hot around the globe. Credit was flowing. The Fed pushed rates down to 1% after the tech bubble crash. ECB was around 1%. Bank of Japan was about 0.2% on interest rates. So you had the three major central banks in the world pumping out basically free credit. And nobody likes free credit better than investment bankers and others that can use this money to create all kinds of new products. And sure enough, they created a ton of derivatives, as we know. The derivative value outstanding, the nominal derivative value in the U.S. economy, in the globe. And again, not all these are bad. Some derivatives do a very good thing, and they provide a lot of flexibility in our financial system and given us a lot of personal financing flexibility, these plain vanilla derivatives, so they're not all bad. But the number went from about 20% back in 1980 relative to the size of the total global economy. Derivatives outstanding represented about 20%. Fast forward to 2007, and derivatives value outstanding grew to 9 times the total value of global GDP. 9 times. That's massive amount of liquidity, of leverage in the system and liquidity created, and that's why we saw such a massive bubble in all the asset classes moving together, and I'll show you a chart of that later. The weight of all that liquidity from the central banks creating or spurring these derivatives where they packaged everything and anything and sold it and resold it and created liquidity everywhere. That came to an end, as we know. The credit crunch hit. So now we have frozen demand. We basically have just seen the demand fall off the cliff in a way that we haven't seen since the Great Depression, and probably the speed in which it has fallen in a period when we're not in a depressionary situation is what's so scary. Demand is basically evaporated. And if you want to do just a little bit of research, and I don't have this chart in here, one of the best ways to see global demand is look at the Baltic freight, the Baltic index of shipping. You know, we've seen some of these indices fall, 85, 90%. We saw the rates for leasing these ships that have cargo back and forth from the export countries to the west, the demand side countries. Basically, the rates have fallen off the cliff because nothing's being sent and nothing's being bought. So we have credit freezing, as we all know. We've been in a period of massive deleveraging, and that's why the central banks have panicked, basically closing down our financial systems. Credit has to flow at some point, some way, to maintain a financial system. Deflating. We've seen a massive amount of deflating going on, not only in just the credit expansion itself, but every major asset class has deflated, and that's a key part of this, because as asset classes deflate in a very, very big way, with so many people, retail and institutional, exposed, it's what has led to this backup in demand. People are very, very scared. They've lost so much wealth. So we've gone from a period of relative risk appetite, everybody taking chances, stretching for yield, looking for those emerging market opportunities, because when credit's free, those are the things you do. And we think we're entering a period of sustained risk aversion. And again, we're talking a long-term period here. We're talking a number of years. We think we're going to be in this sustained risk aversion environment. We're not saying that it's going to be as nasty as it's been, but what we are saying is we're not going to see a return to those periods of massive liquidity we've seen in the past because of regulation, because of just changes in people's temperament. They've lost so much money. Institutions are chased in a way. So we think this return of this major risk appetite period we're not going to see it. We think it's dead in this cycle for a long time.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.